Ottawa home prices since the peak in 2022 have collapsed. The average residential sale price has dropped almost $90,000. The average detached property is selling for about 12% less, but that's just the city-wide number. Some neighborhoods have been quietly losing their value faster than others. And there are some homeowners that are sitting on six figures of lost equity right now without even realizing it. For some very quick context, March 2022 was the absolute peak. Detached homes were averaging around $1 million in Ottawa, condos were pushing $500,000, and everything was selling in days rather than weeks or months. Interest rates were hovering around 1 to 2%, and inventory was basically non-existent. Today, prices are down, and we're sitting at about 3.4 months of inventory, which is still technically seller's market territory, but that number is climbing. The market's corrected and is still in the process of correcting in some sections of the market, but that correction was not even. And that's what we need to talk about today. In this video, I'm breaking down 4 of the Ottawa neighborhoods that got hit the hardest. And each one has a bit of a different story behind it on top of the general market decline that we just talked about. Let's get into it. Let's start with downtown, the Byward Market, Centertown, the whole Lower Town corridor. That story isn't just about falling prices, it's also about what happens when too much product hits the market at the same time, and at the exact same time the demand for that product disappears. This section of the market has been dominating the headlines more than the other ones we're going to talk about, but there's a reason for that. The condo segment in downtown Ottawa is sitting at nearly 8 months of inventory right now. For context, a balanced market is anything between 4 and 6 months. Citywide, apartment condo prices are down over 15% since the peak. But the real number that tells the story is the supply. During COVID, investors poured into downtown condos. Short-term rentals were like printing money, and the units kept being built. Then that investor demand abruptly vanished when the rates went up. The short-term rental income dried up, especially with the rule changes for Airbnb, but the supply didn't. New mid-rise condos kept being delivered, and now all of that product is sitting on the market competing with each other. I am seeing some condos that sold for between $350 and $375 in 2022, now listed at $290, $310, and still sitting there. If you bought a 1-bedroom condo downtown at the peak, you could be looking at between $50,000 and $70,000 in lost equity. Now, if you're a first-time buyer planning to live downtown for at least 5 or 10 years, this actually could be a good window of opportunity for you. You're going to be getting more value per dollar than you would have 2 years ago. But if you're an investor banking on quick appreciation, or you think you may have to move in a couple of years, the math is probably not going to work out in this oversupplied downtown condo market. The second micro market I want to mention is Vanier and Overbrook. Now, this is a completely different story. This is less about oversupply and more about a neighborhood whose prices never really caught up with the potential. Vanier has been called up and coming for the better part of a decade, probably even longer than that. It's close to downtown, it's relatively affordable, it's got great zoning flexibility, and during the pandemic, buyers started pricing in the future potential version of Vanier. The one with the revitalized Montreal Road, new restaurants, young families filling the streets. Detached homes that were in the low 400s in 2019 abruptly shot past 600,000. People weren't just paying for what Vanier was, they were paying for what they expected it to become. The problem, of course, is that the reality of the neighborhood never really caught up with those prices. The revitalization is happening, but it's happening slowly. Montreal Road is still a work in progress, and in a balanced market, buyers stop paying for potential. They start competing on fundamentals, schools, streetscape, amenities, the stuff that's actually there right now today. And when they compare Vanier to other East End established neighborhoods and suburbs, bigger lots, better schools, and a similar price point, a lot of them choose the safer option. And the pricing really reflects that. Benchmark detached homes in Vanier have dropped from the high 600s to just over 500. And the semi-detached section of the market has dropped well over 20%. If you were planning to buy and renovate, these costs have climbed significantly too, which makes the math even tighter if that was the reason you bought the place. Now, long term, there's still a lot to like in Vanier. That potential is still there. The proximity to downtown is real and is not going to change. The zoning flexibility creates investment opportunity, and eventually that revitalization may move the needle. But if you're buying here today, make sure you're going in with your eyes open. You need to be comfortable with the way the neighborhood is now, not just the way you think it's going to be in a few years. The next section of the market that got hit pretty hard is rural properties. Places like Osgood, Greeley, Carlsbad Springs. This is a different story again. This is about a lifestyle bet and an assumption that you wouldn't have to commute that ended up not paying off. During the pandemic, everybody wanted more space. Work from home meant that the commute didn't matter as long as you had a solid internet connection. 30 to 40 minutes outside of the core with septic and well on half-acre lots, these sorts of places exploded in value. Detached homes that would have been under $800,000 pre-2020 were suddenly selling for over $1 million with no conditions in 2021 and 22. The benchmark price in Greeley and Metcalfe shot over $1 million in that period. Then offices started calling people back. Gas prices went up, and suddenly that 40-minute commute each way, twice a day, started to matter again. The people who paid a premium for space when they didn't think they'd have to factor in that commute are now stuck with the commute and a price that reflected a world where they didn't have one. Properties in these outlying areas that sold in a few days in 2022 are now sitting for weeks or months. Some of those places that sold for 1.1 or 1.2 million are now trading below $900,000. That's a $200,000 to $300,000 swing for people who bought at the top, and the sales volume has slowed down as well. If you love the rural lifestyle and you want this place to be your forever home, these areas still offer great value and quality of life. But if you might need to sell within a few years, understand that you're outside the core demand zone and in a flat market right now. So that distance adds a little bit more risk to buying a place like this. Now this last one might surprise you a little bit, but it's Riverside South and Finley Creek. These are popular suburbs with great schools and are awesome for young families. So why is it on the list? And this isn't the same story as downtown or Vanier or those outlying areas. This is about who you're competing with when you're trying to sell. These are construction-heavy areas. Builders are delivering new townhomes and singles constantly, not at the rate that they were, and the new starts have really slowed down, but they are still releasing new projects as of now. And every new unit that comes to the market from a builder is a direct competitor to anybody looking to resell in this area. If you're a 3-year-old townhouse and there's a brand new one down the road that still has its full Tarion warranty, maybe a better layout and a builder incentive package, buyers are going to look at both, and the new one has some advantages you can't match unless you price really well. What I'm seeing on the ground is that resale townhomes in these pockets are taking a little longer to sell and often closing below what sellers expected. Citywide, townhouse prices are down only about 3 or 4% year over year, but in the areas where there's new construction, this pressure on resale can feel a little bit sharper than the headline numbers suggest. Now, long-term, the South End still has strong fundamentals. The LRT extension is supposed to be coming to Leitrim. There's going to be steady demand for this area for young families as well. But right now, if you bought a pre-construction townhome in 2022 and you need to sell it, the number on your statement may not match what the buyer will pay. This gap is real, and pricing honestly for this is the only way to move the property. Now, I definitely don't want to leave you thinking that Ottawa as a market is falling apart, because it's definitely not. Ottawa is still one of the most stable markets in Canada. The pattern across all 4 of these areas is clear. Each neighborhood had a specific vulnerability on top of the general market shift we saw, frankly, all across Canada. Oversupply, speculation, a pandemic lifestyle premium, or builder competition. When the conditions changed, that vulnerability got exposed. Meanwhile, neighborhoods driven by real end-user demand, Barrhaven, Canada, Stittsville, Westboro, the Glebe, they all held up pretty well. Families buying homes to live in, not to flip, not to speculate. The demand hasn't disappeared, people just got pickier because frankly they could afford to be. Ottawa's market didn't crash, it corrected. If you're buying in 2026, the smartest thing you can do is understand what made each area vulnerable so that you're not the next person to get caught on the wrong side of a shift like this. If this was helpful, please consider liking and subscribing. I break down the Ottawa real estate market every month. And please don't hesitate to reach out if there's anything at all that I can do to help you. Thanks so much for taking the time to watch, and have a wonderful day.